So I guess positioning this session in the context of the last one, what I guess Karen's world is looking at is, stocks, where to invest, etc. That certainly is a very important decision, but compared to what I look at, it is a separate decision. My world, so to speak, is more based on, well, once you've made that decision as to which shares or property, managed funds, term deposits, whatever, then what is the best way to structure that? How can we hold it? And often the solution to that involves superannuation and the rules and regulations and benefits that are surrounding those. So I thought I'd start off with the most important slide, which is my disclaimer. Really what that should just say is that I'm here to provide general advice, and for personal advice, please do see your financial planner. It should really just say, speak to your planner, and it probably would say that had the lawyers in Sydney not have got a hold of my slides. We'll start off with a quick introduction to super before we start looking at the self-managed fund market. So this is the more agnostic superannuation as an actual vehicle, and includes self-managed funds, public offer funds such as BT, industry funds, corporate funds and the like. So would someone like to have a go at how they see superannuation? What is superannuation to you?
Retirement savings.
Yeah, retirement savings, yep. Anything else? Okay, that's sort of the explanation that I like to give if I'm speaking to someone my age or younger. Money for your retirement, it's money that your employer puts away that you can't touch till later, and that's a perfectly good explanation. The way I look at it more is that superannuation is just a tax structure, and the closer that we are to retirement, the less of a deal it is that we can't access it broadly until retirement, and the more that we can use the three pillars of tax benefits for superannuation. So no matter how complicated the superannuation rules get, we're talking about one of three things. We're talking about money going in, which are contributions. Now, broadly speaking, we can put up to $25,000 or $35,000, depending on our age, each year into superannuation, and that only gets taxed at 15%, which compares very favourably to most people's marginal tax rates, which can be up to 46.5%. So there's a carrot of that tax concession, with the cap there being a limit. Superannuation in that regard over recent years really has become far more of a marathon, or at least a middle distance race, than the sprint it used to be, considering the limits that we have to how much money we can put in each year on a tax effective basis. Our second tier is the earnings. So whilst that money is invested in superannuation as our tax structure, it's earning dividends from shares, rent from property, interest from term deposits, etc. And they are also concessionally taxed inside super compared to outside. By generating these earnings inside the superannuation environment, we only pay 15% tax whilst our money is in accumulation phase, or whilst we're continuing to add to our superannuation. And that gets even better when we start drawing a pension from our superannuation. That rate actually falls to 0%, which again, 15 or 0 does compare extremely favourably to the marginal tax rates. The stick here is that, well, when we eventually withdraw, the last thing the government wants from a policy perspective is for everyone to use all these tax concessions and then rip it out the next day and spend it on whatever. The system wouldn't really have any integrity if we didn't say, well, we have to wait until retirement or other events in order to be able to access it. That's also the third layer of the tax concessions available. It's a bit more complicated for over 60, but we can access our superannuation either tax-free as a lump sum or an income stream upon reaching age 60. So what is superannuation? It is a tax structure, and putting it as simple as possible, the money you put in, plus whatever it earns whilst it's in there, is money that you can eventually take out someday in one way, shape or form. Moving now to the self-managed funds market, which is, as I said, a subset of the superannuation system. I thought it'd be good to start off with a few statistics. So what the first two there tell me is there's a lot of people in self-managed funds, almost 1 million, so we're talking close to 5% of the population are members of a self-managed fund. The next couple there, the fact that there's almost $500 billion in investment is an incomprehensible amount of money to me, and it represents about a third of the total superannuation pool of 1.5 trillion, which certainly per capita is far more than any other developed nation. The second bottom one says to me, well, during last financial year, this is still very much a growth market, not only in the amount of money involved, but the amount of people involved. There are over 6,000 funds established versus a couple of hundred wind-ups. The next one there I think is a very important one, and that is compared to the general population, on average members of the self-managed super funds are generally a lot older, in the sense well over half of the members are over 55. The two key points I say to that is that, well, people that are in that position should really be looking to move their superannuation from accumulation phase to pension phase to get even more tax advantage from those zero tax on earnings rather than the 15% in accumulation phase. And it also adds, I think, to the argument and an increasing importance going forward is to the estate planning piece, as to what is the next generation that's going to take over and how can we structure things so they can continue to do so in the most tax effective manner. Superannuation is very broad as far as the investment, especially self-managed super funds. There's very little that we can't invest in inside super that we can purchase outside. So they include shares, property, we can use it to hold in insurance, fixed interest, term deposits, cash accounts, etc., etc. It is extremely broad and very flexible if you want to effectively make your own investment decisions to be able to use a self-managed super fund as a tax-effective structure to do so. I've listed a few key considerations and advantages and disadvantages of comparing self-managed super funds, i.e. managing it yourself or being responsible yourself, compared to just having it in a fund such as Perpetual BT, etc., where somebody else is effectively managing your money for you within certain guidelines. In summary, it really comes down to choice versus responsibility, as in having that self-managed funds allows us to directly pick what assets we want to invest in. However, there's a whole heap of rules that we're responsible for following, and for all these sorts of things it certainly is important to seek that personal advice from your financial planner so that your self-managed fund stays a complying self-managed fund and doesn't end up what I like to call a self-mangled superannuation fund, which can cause all sorts of troubles and penalties. Some of the other comparisons, I've put cost there on both sides. The fees that are charged in order to establish, maintain a self-managed fund are generally more fixed than the percentage-based fees that you would tend to pay from another company managing your superannuation money. So it varies depending on what exactly you're using it for and what the costs are, but it's certainly a consideration as to how much the self-managed fund structure is going to cost versus the percentage fee that might be paid elsewhere. There's a whole range of also greater flexibility when it comes to self-managed funds involving estate planning or even gearing in super, which is a reasonably new thing that I'll touch on a little bit later. There's a ton of rules involving superannuation, especially self-managed funds, and I've listed a couple of the big ones there. So the overriding theme of our self-managed fund involves the sole purpose test, which basically states the money that's invested when we're wearing our trustee hat has to be for the benefit of members of their retirement. Now, sounds a bit counterintuitive, but when you're a member of a self-managed fund, you're also the trustee. You effectively have to wear two hats. Every single thing you invest in from the self-managed fund has to be justified by we're doing so for the benefit of the retirement benefits of our members. Not because we think it's cool to invest in something or you want to help a friend out, etc. The overriding theme is that it has to be for those retirement benefits. We've got some other responsibilities as being a self-managed fund, and that is to establish and maintain our structure in a complying format. So broadly speaking, if we're a member of the fund, we also have to be a trustee. So if we're getting the benefits of being the members and the opportunity and the choice, we also need to have the responsibility of being the ones that basically the ATO knocks on the door if there's problems to blame. There's one of two types of structures. We have an individual trustee, which is simpler, but it can be less flexible in various future situations, where it's just a matter of the individuals are the trustee and the members. We can also go down the corporate route, which can provide some other benefits and opportunities, whereby we basically establish a company and say, okay, the two members or 3 or 4 members are all directors of that company, and they are all, ipso facto, all members of the self-managed fund. One of the other key points of a self-managed fund, other than the sole purpose test, is the fact that it has to have an investment strategy. Now, this is seen as being, I think, a little bit negative. I see it as more being a defence mechanism and an opportunity, in the sense that we have to state what our investment strategy is, and if the ATO ever looks at it, they're not really assessing the quality of the investment strategy, merely that one exists and it has been followed. So if it does end up that one of the investments might turn sour and we have to justify our position, you can use the investment strategy to defend it, to say, well, okay, that particular investment didn't work out, but we had a plan in place and we followed it, and that in itself is enough to satisfy the ATO, versus not meeting that requirement. It's a much more difficult argument to say that you followed a strategy which you can't provide documentation to prove. The most recent change for that in the last one, I think that has been blown slightly out of proportion, but that is that the trustees must give consideration as to whether or not it's appropriate to hold insurance for the members of the fund. So insurance in that context, as Karen mentioned, Australians as a whole are very underinsured when it comes to life, TPD, income protection, etc. An example of following that could be, we've considered insurance and we've decided to address that by holding this policy for this member. Or even something as simple as, in the case that we don't have that insurance, we've considered it but determined that we don't want to because we hold cover elsewhere, we can't get the insurance. Insert any one of a number of reasons, age, circumstances, etc., as to why that insurance policy is not in place. And it's not something you have to do, it's just something that the law requires you to give a consideration to, and again, documenting that for potential defence later on. There's quite a few moving parts to a self-managed fund, and the various people may be wearing different hats, but it certainly does show that there is a bit of a commitment involved in being the responsibilities of the trustee, and also engaging in the appropriate professionals to ensure that the fund is complying and ultimately meets the objectives of providing sufficient funding for your retirement in that tax-effective vehicle. Might close with a few strategies, and there is quite a few, and that is a big part of my universe. We have a situation, we have amount of money, etc. How do we most effectively use the tax benefits and the investment benefits of superannuation in order to end up with more money in our pocket at the end of the day, rather than being in the government's? So the first one I think I'll look at there is that there's a broad rule in superannuation that says if you own an asset, like you, your wife, your daughter, your company, etc., that we can't have our self-managed super fund buying that from that what's called a related party. It then lists a whole heap of exceptions, and the main three are listed securities, business real property, and units in a widely held trust, i.e. managed funds. There could be an additional opportunity if we hold an asset, say for an example a business property, a commercial premises, farm, warehouse, that sort of thing, that we don't want to sell, but we want to be able to hold that asset in the superannuation environment. So the law allows us to do it, and why we're doing it really comes back to the first slide. As in, if we have an amount of money that we don't spend, it has to be invested somewhere. Where would you rather it invested? In an individual name paying your marginal tax rate on the subsequent income, say rental from the property, or inside the tax-effective superannuation environment? There's a range of considerations here. I won't have the time to go into them, but there's a range of considerations including triggering off capital gains tax liability when moving an asset that we personally hold into superannuation, potentially stamp duty implications, and also contribution caps, because it's restricted as the amount that we can put into superannuation each year, even as an after-tax contribution. Another strategy involves a small to medium business structure. So this is how some of you who are business people might see how your business is operated. We could say we have the company that operates the business, and the two people within that are the employees and the shareholders of the company that are receiving dividends or even salary as employees from that. It can certainly be very tax effective in this case to have that company run the business via the individuals, and yet the business premises be held inside the self-managed super fund. So while you might look at that sort of situation and say, okay, we've got a super fund owning a property, a company's running a business, paying rent to the super fund, and then hopefully the company makes enough money to be able to pay its employees' wages and shareholders' dividends. The way I look at that structure is not self-managed fund, company, individual. The way I like to look at it is we have tax rates. Superannuation at 15 or 0 on the rent that it's receiving because it owns the property, the company claiming a deduction. So even though we're talking about the same people in this situation, by using the different structures, we can have a company paying the rent and getting a deduction at 30% for that expense, compared to the super fund who has to declare that as assessable income, but is only paying 15 or 0 as a tax rate. So it's certainly a great arbitrage opportunity with the overriding theme of we have to pay enough rent, or what's called market value rent, to be able to justify that it's a good investment for the superannuation fund. I thought I'd mention borrowing. It's an extremely complicated area, and there's a whole heap of requirements that need to be met for it to be complying. The main ones being is that the borrowing is used to purchase a single acquirable asset, which is why in probably over 99% of cases we're talking property. There's nothing preventing you from borrowing inside the self-managed fund to invest in shares, but considering that each share is a separate asset, if we wanted to say hold a portfolio of 4 listed securities, then we'd have to have 4 separate borrowing arrangements. So it's generally cost prohibitive when it comes to shares. It can be an even better opportunity in relation to property, especially if you're a small business owner and don't currently have enough money in your superannuation to be able to buy it outright. We can use gearing to help fund that purchase, and again that might even be from a related party if we're talking business premises, and be able to really add some steroids to that tax effective nature of the superannuation system. It could also be an opportunity in a passive situation whereby rather than borrowing in our own name, we may wish to do so in superannuation to give that bigger boost, and hopefully the returns on that will outweigh the borrowing costs and increase our retirement benefit thereby more than otherwise would have been the case had the borrowings not been involved. That's the sort of structure that we're looking at as far as the borrowing. So I think it is important to mention just how complicated the structure is. And pretty similar to the last slide, we've got the rent coming from a tenant, which if it's our business real property, commercial, farm, warehouse, factories, etc., can be a related party, or if it's residential, it has to be leased to basically someone who's not us, our relatives, our companies, etc. In this sort of structure, the banks in the vast majority of cases will ask for a personal guarantee. So one of the rules for the borrowing in super is that none of your superannuation assets can be put at risk other than that single acquirable asset that we're borrowing for. So from the bank's point of view, it's not necessarily a particularly safe loan, that in itself, that can only really attack one asset. So they'll often say, okay, you're promising that if we attack this asset and we don't get our money back, then we can come knocking on your door as an individual. So there certainly is, with any borrowings, risks involved, as well as the potential benefits and the tax arbitrage that's associated. I'll close on the insurance piece. So this is the potential benefits of holding our insurance inside superannuation. It gets far more complicated for other types of cover and other types of beneficiaries, but let's just go with a simple example. If we're talking life cover, in the event that we pass away, our funds would be paid to what's called a tax dependent, such as a spouse or child under 18 being the most common of the two. Given the premium cost of $1,000, or just, I've made the number simple, for every $1,000 worth of premiums, we have a choice as to how much we're actually going to pay. What that slide shows, and I'll take the upper middle tax bracket of 38.5% for somebody that's earning between $80,000 and $180,000 as an example. For that $1,000 cost of the premium, if we hold it inside superannuation, the amount that our pre-tax salaries or earnings are going to reduce is $1,000. That's because we can fund the premium by making one of those tax effective concessional contributions into super, which is only taxed at 15%. And because that insurance is an expense of the fund, unlike an individual, the fund can claim a deduction at 15%. So the two net each other out, and our $1,000 premium is costing $1,000. Compared that to the cover outside superannuation, where in order to put our hand in our pocket and take out $1,000 to pay out personally, it's effectively going to cost us the $1,626 in that tax bracket examples worth of pre-tax money, because that's the amount we need to end up with $1,000 in our hand once it's passed through the tax system. So certainly yet another potential advantage of superannuation, to be able to tax effectively hold insurance, as well as being the main game being the investment opportunity and the benefit to have a greater say in how our retirement savings is invested, and aim to end up with enough money in that tax effective environment to retire and meet our income needs. The final slide is, again, a bit of a summary as to the benefits of a financial advisor. So we've probably touched on two or three of those tonight. It is certainly a very broad spectrum that financial advisors work across. And one could even adopt the approach of, well, you know, have I or am I about to experience a life event? Getting married, having children, could look at insurance. Am I looking to go into retirement? How are my assets structured? How much tax am I repaying? Am I looking for a new job? Got a pay rise, become redundant, and a whole heap of other life stages as well. I hope that was informative. A little snapshot of the superannuation system and self-managed funds.